Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. By request, I wanted to review what the Smith Manoeuvre is. It is a strategy developed by Fraser Smith from Vancouver Island in a book written in 2002, which answered the question, is your primary residence mortgage tax deductible? The answer is yes, as long as you use the money you withdraw to invest into something that earns income. The Smith Manoeuvre is only applicable to Canadians, I'm afraid, since U.S. residents are able to write off the interest on their primary residence already. Essentially, the Smith Manoeuvre makes your primary residence mortgage tax deductible because you can invest your mortgage payment and you can earn income on it. The caveat, though this is easy to acquire, is to get a re-advanceable mortgage, which is a two-part loan on your primary residence home, a fixed or variable rate mortgage, and a HELOC. A HELOC is a home equity line of credit, a credit line where you only pay the interest and it's secured by your home. Your HELOC increases, allowing you to invest more with every dollar you pay down your mortgage principal, and this is now available to purchase investments. Once you purchase the investments, the interest on the HELOC used to purchase them becomes tax deductible. In all cases, make sure your returns are greater than the interest, or you may just as well pay down the mortgage and be better off. Also note that you are borrowing to invest, and this adds to the risk of the investments, so you must be comfortable with that. Every time you make a payment to your mortgage, your home equity line of credit grows and you will be able to increase the amount you can borrow on your home towards your investments, with the preference for dividend-paying equities in a non-registered account. Borrowing and writing off the interest for TFSA and RRSPs and any tax-deferred accounts is not permitted because those accounts are already tax-favored. Further, the investments need to be earning income, which generally means that the investment should be paying interest or dividends. If an investment will never earn anything except for capital gains, then the interest expense is not deductible. Part of the strategy is to take the proceeds of your investments and put them back into your HELOC, thereby further raising the limit of how much you can borrow to invest. A second version of the Smith Manoeuvre is to sell off all your non-registered investments. Note that there may be tax implications, trading commissions, and early sale penalties, and use the proceeds to pay down or off your HELOC and/or mortgage in the two-part loan mentioned earlier, and then you borrow the money from the HELOC to invest, and voila! The interest is tax deductible, and you have the same or similar investments as before. Any cost on the money used to create income is tax deductible, and loan interest can thus be deducted. For example, my accountant told me that in order to buy U.S. real estate properties for cash, I could get a mortgage on my primary residence and deduct the interest, as long as I could show the CRA that the money went from the primary residence mortgage to pay for the U.S. properties. Please check with your accountant for any of the following, but theoretically they should allow a tax deduction of the interest as long as you are using the money to invest to earn income. So you could just have a HELOC on your home, and as you pulled money from it to invest, interest attributable to the amounts invested would be tax deductible. If you are putting down a large down payment or buying a primary residence for cash, this would apply. This is not the Smith Manoeuvre, however. For the next four examples, I will use an investment property as an example, but that counts as an investment. These are also not the Smith Manoeuvre, but may allow you to write off interest on your primary residence mortgage. If you have paid off your investment property or are buying an investment property for cash, get a mortgage on the investment property instead and use the cash to pay off your primary residence's mortgage. So the interest on now gone primary residence's money is tax deductible via the mortgage on the rental. When it is time to refinance the primary residence mortgage, you pay off your primary residence mortgage and instead get a mortgage on the investment property that's paid off. So you can write off the interest on the rental property's mortgage. Because of the timing, the CRA may flag this, however. It is much better to get a mortgage on the rental property when it is being first purchased, as the previous or the next situation. A similar situation occurs when buying a primary residence while moving out of a primary residence that's paid off and will become a rental. Get a mortgage or a HELOC on the new rental and use the proceeds to purchase the new primary residence. If neither of your properties is paid off, you have two mortgages and you can write off the interest on the investment property's mortgage, but can't do anything about the primary residence mortgage. If you have any requests on what you would like me to cover in future videos, please put that in the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.